The famous investor Peter Lynch said insiders buy because they believe the share price will increase, and today we're looking at 5 stocks with recent insider buying. As you can see on the screen, we have buys of companies large cap over 20 billion, costing at least $200,000 over the last month, and we're starting off with the first one being Oracle, where the director on the 12th of February bought 5,500 shares, costing them just under $1 million. Now, each one we're going to run through a lot of information, and for those that don't know, Oracle is a tech company. They provide database software, cloud computing services, and enterprise solution for businesses. Their flagship product, Oracle Database, is widely used for managing large-scale data, and they also offer cloud infrastructure, enterprise applications, and AI-driven analytics, and they serve industries in the finance, healthcare, as well as in the government. Now, look at the company itself. It has been beaten down year to date, down in fact around 7%. Over the last year, though, it is up 35%, and over the last 10 years, massive outperformance of the S&P, up 266%. Right now, it is on a pullback, trading in the midpoint of the 52-week range, with their 52-week high sitting around the $200 mark, with both Wall Street and Seeking Alpha calling this company a buy, and they do pay a dividend just over the 1% mark. If we do take a look at their earnings, they anticipate their next 4 all to be growth to the EPS. However, over the last 4 quarters, they have missed 2 of them, giving them a 50% track record, and their May 2025 EPS target of $6.15 does mean the company is now trading at a valuation on a forward P of 25.2. Now, valuation grade, they get an F. Bear in mind the company does trade above the sector median of 22.4, meaning you are paying a 12% premium, but they also sit above their 5-year average of 18.5, meaning they sit 37% above their historical figures. Now, in terms of looking at the valuation, other than our own process today, we also want to show you another valuation model which compares the company against the forward P. Blue Tunnel is the expected fair price. Nice to see it increase over time, something you do want from any company you invest in. But right now, there is massive disparity between the current trading price and even the upper end of the Blue Tunnel. That is one signal here of severe overvaluation. But remember, we're not looking at it in isolation. And another overvaluation signal as the forward P does sit above the 5-year. And we also notice the yield of 1.03 does sit below the 5-year dividend of 1.5. So quite a few overvaluation signals that we will get through in our own valuation process. And their growth grade is a D-. Now, revenue year on year at 6.5%, as well as over the next 12 months anticipated 9.2%, is above the sector comparable at 5 and 6% respectively, but also a little bit above their own 5-year averages of 6.4 and 6.5. And we do also note they're anticipated to grow their earnings per share 11% over the next 3 to 5 years, when in comparison the sector does sit higher at 15, but their own 5-year average does sit a little bit lower at 10.1. In terms of looking at their profitability, they do get an A+, gross margin 71%, above the sector at 50, but below their 5-year of 77, and their bottom line 21%, well above the sector at 4, but a little bit below their own historical 22.6. Cash from operations, though, significantly high at 20.3 billion, considering the sector sits at 104 million, and even their own 5-year average is lower at 14.97, meaning they are continuing to generate a lot more cash as time goes by. And in terms of institutional ownership, sitting at 42%, 14 billion worth of sales by the institutions over the last year, but we get a lot more buying at 20 billion, and we also notice nearly twice as much buying in the most recent quarter, Q4 of 2024, meaning institutions continuing to be very bullish on Oracle overall. Now, our intrinsic value comes to $163, derived from the DCF model. Now, you can see the free cash flow year on year, average growth at 6%. Moving forwards, we've gone 15% in line with analyst targets, but we do have a low, medium, and high here. And as always, numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running to your own numbers, whether it's for Oracle or any others. And at the 15% point, with the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get to 163, indicating 5% upside. Now, full transparency, we'll show you at the 10% point, $105, downside of 32%, and at the 20% rate, $244, indicating 57% upside. Now we like to typically take the median rate into the final slide at 15%, where we always apply a margin of safety, 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. And this highlights right now that for Oracle, we aren't even getting a 10% MOS. At the 5% is where the company sits right now. However, Wall Street, as we saw earlier with their buy signal, see this at $195 over the next year, indicating 26% upside. So let us know your thoughts below. Is this a buy at 5% MOS, or in fact, are you waiting for a larger MOS at 10%, a buy at 147, at 15 around 139, and at 20 around 131? As we said though, only 5% margin of safety at today's date. We also want to let you know we have just released our latest free weekly article. We drop one every single Monday morning to your inbox, where we cover severely undervalued stocks as well as what's gone over the market in the last few days. So click below, you can sign up, read straight away, where you'll be able to gain access to undervalued stocks for the month of March. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a recently released copy of 32 stocks that Wall Street see as the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move on to MSCI, where the chairman and CEO on the 24th of February did buy 5,300 shares, costing them just over $3 million. And when we take a look at the company, for those that maybe are a little bit unfamiliar, they are a financial service company that in fact provide investment tools, analytics, and indexes for institutional investors, and they are best known for their MSCI indexes, which help track global stock market and guide investment decisions. They also do offer risk management, ESG ratings, and portfolio analytics, and their solutions help investors assess market trends, manage risk, and optimize their portfolios. Now, the company is down 6% year to date. Over the last 12 months, only up around 2%, but over the last 10 years, massive outperformance of the S&P, up 890%. Right now trading in the midpoint of the 52-week range with a double buy from Seeking Alpha and Wall Street, and we do also note a yield payable of 1.3%. If we look at their earnings, does look good over the next 4 quarters. They do anticipate growth, with the first 3 to be double digit, and they also have a 100% historical track record. Based on the EPS of just under $17, they currently trade at a forward valuation of 33.2. Now, if we compare that against others, straight away, you'll see an F rating. They do look to be trading at a massive premium, in fact, 209%. However, over the last 5 years, on average, they have traded significantly higher, meaning right now it is 25% lower than their historicals. We also do notice an undervaluation signal via this method. In fact, disparity the other way, not something we saw for Oracle. It is actually looking severely undervalued, as it's lower than even the bottom end. We also get confirmation that it is trading lower than its 5-year forward P, and also dividend yield theory telling us the company does look undervalued, 1.28 right now, sitting above the 5-year of 1%. In terms of growth, they get a B-, year on year 13%, forward looking 10.2, well above the mid-single digit for the sector, but not that far off their own 5-year at 13 and 12% respectively. In terms of the EPS, we do notice 11.2% over the next 3 to 5 years, a little bit higher than the sector at 10.2, a little bit lower than their own 5-year at 13.5. Profitability looks strong at an A, gross margin 82%, above the sector at 59, in line with their 5-year. Bottom line 39%, well above the sector at 22, a little bit higher than their 5-year at 38, and they generate a ton of cash from operations, $1.5 billion, when the sector is $149 million, and their own 5-year does sit lower at 1.04. In terms of the institutions, 90% ownership, 4.6 billion worth of sales, a lot more buys at 6.5, and we also get nearly twice as much buying in the most recent quarter, so clearly institutions bullish on MSCI. Now, our intrinsic value comes to $709. As you can see, we have a low, medium, and high. Today we have the 14%, which does give the $709 intrinsic value, equating to 27% upside. Now, at that level, we will get a nice margin of safety, and as we do in fact keep going today, you are getting at least 20% up to 567, not at the 25% level just yet. So for MSCI, between 20 to 25% margin of safety, with Wall Street and their buy rating seeing this at $682, equating to 22% over the next year. Now, for those that believe maybe the median rate is too high at 14%, we can in fact show you at the 12% moving forward, you will still get a margin of safety. And as we go at the 10%, it is pretty much around that level at $548. Again, upside, it doesn't change. But let us know whether or not, even at the lower growth rate, is 10% MOS enough for what we would say is a high quality company. We then move on to Salesforce with the director buying on the 28th of February, 1,695 shares, costing them around $500,000. And we can see this company is a cloud-based server software. They specialize in customer relationship management, CRM. The platform helps businesses manage sales, marketing, customer service, and analytics. And they also offer AI-powered tools, automation, and industry-specific solutions to improve customer engagement. And their own ecosystem includes cloud services like Sales Cloud, Service Cloud, and Marketing Cloud as well. The company has been hammered 15% year to date. Over the last 12 months, down 6.5%. Over the last 10 years though, massive outperformance of the S&P, up 338%, right now trading in the mid to lower end of the 52-week range, with a double buy from Seeking Alpha and Wall Street, and a yield payable on the lower end at 0.57%. If we look at their earnings, they do expect growth over the next 4 quarters, with a 75% historical track record, right now trading at a forward valuation of 25. In terms of their grading, where they do get an F, they are trading at a premium to the sector at 22.4. You are paying 13% more, but in relation to what they've traded for over the last 5 years at 42, right now it does sit nearly 40% lower. Again, we do get another undervaluation signal. However, we do want to point out that over time, the expected price has been decreasing. Not necessarily a sign you want to see from a company you're invested in, but we can see even now disparity between the lower end of the fair price and where the company sits. In terms of then reconfirming, we can see the forward P does sit quite some way below their own 5-year, which is typically a potential undervaluation signal. They do get a C on the growth grade, where year on year 9% and forward looking is the same, with the sector a little bit lower in the mid-single digit, but historically they have grown at a faster rate on their top line at 20 and 17%. And over the next 3 to 5 years, EPS at 17% is expected to outperform the sector at 14.6%. But over the last 5 years, again, not just the revenue increasing at a faster rate, but also the earnings per share. Profitability looking as strong as ever with their A+, 77% gross margin, well above the sector at 50%, also above their 5-year at 75%. Bottom line, 16%, above both sector at 4 and their 5-year. So whilst they may be growing at a slower rate, they are improving their margins, both gross as well as bottom line. And the cash they generate significantly improving at $13 billion, when over the last 5 years it sat at 7.31, and the sector in comparison sits much lower at 104 million. Institutional ownership sitting at 80%. We do in fact notice over the last year 23 billion worth of sales, 31 million worth of buys, and more buying in the most recent quarter. So similar with the previous companies today, institutions are bullish on Salesforce. Now, intrinsic value, $371, we have used a 12% growth rate moving forwards, where we have a low, medium, high of 10, 12, and 14, and we do get a nice margin of safety, as we do in fact keep going in today's episode. You're not getting a 25% just yet, not that far off at all, so sitting somewhere between 20 to 25. Wall Street very bullish with their buy rating. They see this at $385 over the next year, translating to 37%. Again, we can show you for those that believe the lower rate is more applicable at 10% moving forwards. You would get a margin of safety of at least 10% up to 290, but around the 10 to 15%, and Wall Street, as we can see, regardless, are very bullish. We then move to CVS, where the director on the 18th of February did buy around 30,000 shares, costing them around the $2 million mark. And for those that don't know, CVS is a healthcare company. They operate pharmacies, retail clinics, and insurance services. They own CVS Pharmacy. They provide their healthcare through Minute Clinic and offer insurance via Tina, and they also manage pharmacy benefits and deliver home healthcare solutions whilst aiming to make healthcare more accessible, more affordable and more integrated. The company is down around 11% over the last 12 months, but over the last 10 years, even worse, negative 36%, they have massively underperformed the S&P, whilst right now trading in the mid to upper end of the 52-week range with just one buy rating from Wall Street, and they do pay quite a high yield around 4%. In terms of their earnings, over the next 4 quarters, they expect 2 of them to be a decrease, whilst having a 50% historical track record. Right now, though, their forward valuation does sit at 11.3. If we compare that against the sector of around 18, you are getting a 37% discount, but if we compare it against their own 5-year, it does sit around 15% higher, and we also get an overvaluation signal here, as in fact we can see it does sit above, but also do notice the expected fair price has been decreasing over time. We also can reinforce that the company does trade above their historical 5-year average, but also their dividend at the moment of 4% is above their historical offerings of 3.12. In terms of their growth grade, well, year on year and forward looking around the 4% mark, with both sectors sitting higher at 7% and their own 5-year averages of 10 and 7. In terms of their EPS though, that is expected to grow at quite a significant rate, 23%, when the sector in comparison sits at 11 and their own 5-year even lower at 5.8. Profitability comes in at an A+, gross margin 13%, sector a lot higher at 60, their own 5-year higher at 17, bottom line 1.24, which is very low, but then bear in mind the sector has been losing money, negative 4%, and their own 5-year does sit only a little bit higher at 2.2. They've generated just over 9 billion of cash from operations over the last year, but sector has been burning through cash, negative 14. Over the last 5 years though, they have on average generated a significant amount more at 15.3. In terms of institutions, 81% ownership, 6 billion worth of sales, but more buying at 9.5, and we also noticed pretty much twice as much buying by institutions in the most recent quarter. If we then get to our own valuation, we see $75, so you are getting a margin of safety today of at least 10% up to 67. Wall Street themselves, they see this at $71 over the next year. That is only 8% upside, but let us know with these stocks that we are going through whether you see them as a buy, hold or sell. We then move on to Diamond-backed Energy, where we see on the 28th of February the director buying 2,000 shares, costing them just over $300,000. And for those that don't know, it is an independent oil and gas company focused on exploration and production in the Permian Basin, and they specialize in acquiring, developing and extracting oil and natural gas resources whilst emphasizing cost efficiency and operational excellence. They also do play quite a key role in the US energy production, with a focus here on sustainable growth. If we look at the company, they have been hammered 15% year to date, over the last 12 months down 23%, and over the last 10 years they are up around 100%. Again, bear in mind, this is if we look at the performance against 10 years today, but if you're someone who bought this at the COVID lows around $24, you would be up very significantly. Right now, they are trading pretty much at their 52-week low, with a buy rating all across the board, seeking alpha, Wall Street and Quant, and even higher yield than what we saw from CVS at 4.7%. In terms of their earnings, again, bear in mind, cyclical industry, they anticipate growth from 2 of the next 4 quarters, whilst having a 75% track record, and right now they are trading at a forward valuation of 8.95. In terms of where that sits, well, sector is higher, so you are getting a 20% discount, but you're also getting a discount in comparison to the last 5 years, where they have sat around 11% higher. If we then take a look at this valuation, we can see it is sitting pretty much at the upper end, so reasonable valuation / possible overvaluation. And then we take a look, it is slightly above their 5-year average, and their dividend yield isn't that far off, so you could argue all of these signs are pointing to a reasonable signal. In terms of growth, they get a C+, year on year 33%, forward looking 22%, well above the sector at the low single digit, and also pretty much in line with their own 5-year historical figures. In terms of EPS, expected to grow at 7%, a little bit lower than the sector at 8%, and also a little bit lower than their own 5-year at 8.3%. If we look at profitability, they get a B. Gross margin 76%, well above the sector's 45%, lower than their 5-year at 83%. Bottom line, 32%, well above the sector at 10%, but also above their own 5-year where they were losing money at -4%, and we can see a lot of cash generated from operations, 6.4 billion, sector at 572 million, and their own 5-year lower at 4.5. We notice institutional ownership is fairly high at 90%, with 3 billion worth of sales, twice as much buying by the institutions, and a lot more buying in the most recent quarter. So like the majority of stocks, if not every stock today, institutions as well as insiders are very bullish. Our intrinsic price is $183, which does give a very nice margin of safety today. You are getting at least 20%, not far off 25 again, so you could say for FANG 20 to 25% MOS, with Wall Street themselves very bullish. They see this at $211 over the next year, translating to 51% upside, and give us your thoughts whether or not these stocks, or this one in particular, is one that you have now on the watch list. Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in a Patreon where we do cover our weekly buys and sells, and as always, have a great day. We'll see you all on the next one.